Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Dietrich, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Dietrich, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi everyone, welcome to Facts versus Feelings, episode 112. Three things we are worried about. That's what we're titling this episode. Last week we did 5 things we're thankful about, and just so that nobody calls us perma-bulls. I almost said perma-bears. There are some things we are worried about, and we always think about what we should worry about or what we ought to be worried about, whether it manifests or not. But to that end, when I say we, obviously usually it's Ryan and me, but my absolute pleasure to be joined by a colleague and good friend, I should say, even though we've been working together for just about 15 months now. Barry Gilbert. Barry, last week Ryan had his turn with you. Today it's my turn. So, you're doing the rounds. So welcome.
Glad to be here. We're doing things that we're worried about because I think we're all cup half full kind of people, but Ryan's our cup half full anchor. He is not a perma-bull. I have heard Ryan say things that are bearish or have concerns at different times, but he is somebody who has an optimistic outlook on life. And so if we're going to be worried, it's me and you who are the warriors right now.
I know. And my title is Global Macro Strategist Vice President here at Carson. And global macro strategists are supposed to be the warriors. There's always something to worry about, when you're thinking globally. But on that note, Barry, I know we have to give titles. So what is your title?
Asset allocation strategist and VP. And asset allocation strategist means I think about stocks and bonds. And when I put on my bond hat, I get worried because you're supposed to do that when you have your bond hat on. When I have my stock hat on, I'm much more optimistic.
There you go. And I know last week, the last week's episode, the one you did with Ryan, I was listening to it when I was on a train ride down in India. I was traveling from, my sister's place over to where my parents are, but 2 cities probably separated by about 300 miles or so. But 300 miles in India takes a much longer time to get across for any number of reasons that, that we can imagine. But no, I took a train ride. It was fantastic to listen to both of you. But I know you talked about how you help, what you do basically, right? Maybe we can just cover that for new listeners here who may not have heard last week's episodes, which I definitely recommend. So Barry, maybe you can cover it from this perspective, how you and I work together. Maybe that's more, just to put a different spin on it.
Yeah, I think we do a lot of the same things, but from different perspectives. We come from different disciplines, we're different people. We bring a different point of view to it. So I read a lot of your stuff. I edit your stuff. I love reading it. It's some of the favorite stuff out there I've ever read.
Wait, just so that everyone knows, Barry edits all my stuff. So Barry's the poor guy who's been, through the short straw of editing my stuff. But no, thank you for that. Go ahead.
And so your key question is always what's going on under the hood. There are other things that you look at. You can answer a lot of different questions, but I think that's the sort of a first analytic question that you ask. I like to look at what's underneath the hood, but I think my first question is what's the big picture? And then I go to under the hood. So we have a lot of crossover. We both ask both questions, but I think it's the perspectives that we bring to it. And that's kind of part of what I'm supposed to do, is to be able to take a lot of different perspectives and pull them all together. So I need to understand my own perspective, a little bit of what you do, a little bit of what Ryan does, and work with the whole team to help see what the final view is when all of this stuff sits together. And I got to say, at Carson, it's a pretty easy job. We have great conversations. We have disagreements, but it's always in the spirit of getting to the truth, and we work together really effectively. And I think we share some very common values as well.
Right. I think on that, how I like to think about it is, it's one thing to have I mean, everyone has a big picture view, right? Like, oh, and most people have been negative. That's my big picture view, but that's fine, right? And we've been positive over the last couple of years. But it's one thing to have those big views. It's a whole other thing to build a portfolio out of it. And I feel like that's where, you're so good at that, like bringing all that together and saying, okay, because at the end of the day, that's where rubber hits the road. Right?
That's exactly it. And that's the, with all the work that we do, that's the final point that we're getting to. It's not just giving advice or, it's very easy to just be a talking head, but ultimately, we have to put together actual portfolios that get real world returns that matter to a lot of people. And so that's really where it all comes together. And that translation process for me is really interesting. And again, something I love doing with this team.
No, absolutely. So side note, I was on my way back from India yesterday, right? Not to go. Yeah, I'll tie this in to what's happening now. So I went through immigration, and for the life of me, I cannot understand why it should take an hour and a half to go through immigration at O'Hare Airport, which is where I landed. Thankfully, I live in O'Hare. I don't have a connection or anything like that. I would have been out of my mind if I had a connection after waiting an hour and 15 minutes or so in immigration. But these are all U.S. citizens, by the way. It was, this is a line just for U.S. citizens. There's a whole other line for people from other parts of the country, other parts of the world, really. And I have to think O'Hare is probably one of the largest entry points in the United States in terms of immigration. So, yeah, I just can't believe why it takes that long for U.S. citizens to go through immigration. And in this day and age, we talk about efficiency and productivity and things like that. I'm like, wait a minute. The U.S. government probably knows more about me than my own wife does. Right? And they probably know more about me than. So I've been coming in and out of the country for about 25 years now, ever since I came in as a grad student in 2000. And and they have my fingerprints, they have my photos, they can probably make a full page collage of photographs of how I've gained 3 chins, even maybe. But I'm like, wait, I boarded a flight in India. I came through London. By then, I spent like 24 hours or so in the train on the plane thereabouts, including layovers, and they probably had every idea like this guy is coming into the country, right? Like, we don't need to make him wait that long. I know it has global entry and all of that. Any of our listeners, I'm sure somebody would be like, wait, you should just apply for global entry. I know that. Yes, I should apply for global entry, but I haven't. And yeah, it just baffles me. And this way, tying it to what's happening now, the Department of Government Efficiency run by Elon and Vivek Ramaswamy, maybe those things they change. I mean, but that's part of it. Like, Barry, you tell me, like, do you think we should have more federal employees, more, customs border protection people? I mean, to make this more efficient, but to deal with 1,000 people, I think there were like 6 officers or something to deal with 1,000 people. So you can only imagine how long it took, right? Why not have 12 people? But I guess we're trying to go the other way, try and cut the federal workforce. We're not trying to increase it. But anyway, just, I had to rant about that. I don't know if you have any thoughts.
I mean, I guess with some process, I don't really have any thoughts, but I guess with some processes, at some point, an actual human being has to look at something and look at you and make a decision, and they try to accelerate that. But there's some parts of it where you actually need to have a person standing there. Maybe one day that won't be true, but that's still true right now. And if that's the bottleneck and you need things to go faster, then yeah, you need more people. But I'm guessing that's a part of it. I mean, a lot of the things that we automate are to take the slowest human elements out of it. But at some point, you can't take it out. It needs to be there.
Yeah, I guess that's the thing for, like, you can have AI run. I imagine you can have AI run U.S. customs, when people come into the country, but maybe we don't want that, to your point. Maybe you want somebody maybe you want somebody to blame even, like, if something goes, God forbid, if something goes wrong, right? Who was the last person to have looked at this guy's face, right? Or woman's face, probably a guy more than anything else. But on that, I was looking at the federal government I know we'll get to three worries and things like that, right? Federal government employment, right? There are about 3 million federal workers, out of which about 600,000 workers are U.S. USPS, basically, right? So 3 million is a lot, but remember, total non-farm employment is about 159 million, right? So the federal government's employment as a share of non-farm employment is about 1.9%. By the way, that is the smallest since 1939. It was over 4% in the 50s and 60s. Started to drop. Interestingly enough, this I didn't know until I looked at the data. Started to drop in the mid 1970s. It was over 3% in about 1980. It dropped to about 2.8% in 1990, 2.1% by the end of 1999, and since then it's continued to drop ever so slowly. But you can only shrink, I suppose. I suppose you can shrink government only so much without people starting to get frustrated with the fact that I'm not getting enough services, right? Anyway, that's just something. I was like, let me look at how many employees the government has, especially now that we're talking about shrinking government and things like that. But on to things you're worried about. Barry, what's on top of your mind?
On top of my mind with things I'm worried about, we've talked a lot about the fact that we think that we have policy tailwinds. Right? We have a policy tailwind from the Fed. They're going to be cutting rates. We're not sure how much, but it's very likely that they're going to be cutting rates. And also from the fiscal side, from Congress as well. Less of a chance of going over the fiscal cliff post-election, possibly some additional tax cuts. But I think that there's a lot of potential for a mistake. Now, that's not our base case, but there are some challenging things going on. And Donald Trump was elected in part to be a disruptor. And disruption can be a powerful thing. And even when disruption goes well, you have creative destruction. You have challenges around that. But disruption is also risky, which is one of the reasons why people are cautious. So if there are a lot of different kinds of policy innovations coming into play, different ways of doing things, each of those has a chance of creating an incremental improvement. But each of those, if they're untested, has a chance of going wrong as well. And sometimes when you start going wrong, you can correct it. Market gives you a little bit of feedback and you can go in a different direction. But sometimes once you get things in motion, it's hard to turn back again. So like I said, not our base case, but probably a policy mistake. Are you concerned about a policy mistake on one side or the other? Or do you think if we had one, it would be more likely to come from the fiscal side, from the monetary side?
At this point, looking at the data, if you'd asked me 2 months ago, I probably said maybe I'm less worried about it. Now we are about, 2.5 months removed from the Fed's first big rate cut, 50 basis points, 0.5 percentage points in September. I was saying, okay, rates are going to go down. We've actually seen the opposite. There's a few reasons for that. Despite the Fed cutting interest rates, so that's short-term interest rates. That's what they're more in control of. Long-term interest rates have actually risen. They above the 10-year is above 4%. And yes, I'm worried about that. I think policy is too tight, right? I think the Fed is easing. Maybe they're not easing fast enough, right? And it's easy to say that, GDP is growing at 2.8, 2.9%. The Atlanta Fed GDP now cast for Q4 is at 3.2%, right? I remember last week you guys talked about Scott Bessent, the incoming nominee for Treasury Secretary, 3, right? Out of one of the threes was 3% GDP growth. Goodness, we're there already, right? We have 3% GDP growth. Just don't ruin it. That's the only thing. What could ruin it? I think it's elevated rates, right? Out of that, even if you just take that 3.2% nowcast for the Atlanta Fed GDP, out of that 320 basis points, 3.2%, investment spending, non-residential investment and housing, residential investment is adding just 26 basis points. You and I and Ryan too have consistently talked about productivity growth, right? And that's been going well. That we need productivity growth. We haven't had that for about 2 decades right now. What do you need for productivity growth? You need tight labor markets, but you also need investment, right? You need equipment spending, machinery spending, factories, all of that stuff, right? And I feel like we are not seeing enough of that. And what's holding that back is higher rates. And that's on the non-residential side, right? Like, investment spending. Even on the residential side, you have the most cyclical part of the economy, which is housing. Mortgage rates are above 7%. I mean, the housing market is not coming back if mortgage rates remain at 7%. And for that, we need longer term rates to come down. Mortgage rates are keyed off of 10-year rates. And so I think my biggest worry is a policy mistake. I mean, there's both the fiscal side and the monetary side. I think it's a Fed. And I'll put it this way, and I'll ask you the question, right? I think the Fed will cut in December. I think the meeting is in a couple of weeks or so. I think they'll cut 25 basis points in December, which means they would have cut 1 percentage point, 100 basis points over the course of September, November, December. I think the market's expecting 2 more rate cuts in 2025. And I feel like, okay, that's a fair case. I think I'm there as well. Like 20, I think we could see about 2 cuts. Not a lot, but just about enough. I think they should do that. My fear is that right now, unemployment is running below where they forecasted. They forecasted unemployment to be 4.4%. It's at 4.1. We don't know what payrolls will tell us in, what November payrolls and for that matter, December payrolls will be. Inflation is staying slightly on the harder side, right? Core PCE, personal consumption expenditures index, that's at 2.8% year over year. And now what's driving that is all these weird idiosyncratic stuff. Shelters adding 30 basis points to that excess of 2.8%, 2.8% over the 2% target, right? So lagged shelter inflation, official data, which Ryan and I have talked about a lot, ad nauseum, to be honest. And then the other thing, Barry, that's actually keeping inflation harder is stock prices. We have this thing, it's weird because within the PCE index, it doesn't exist in CPI. CPI has its own issues, but the PCE index, which is what the Fed prefers to focus on, has a big component in financial services. Part of that is portfolio management services, which is the industry you and I are in. And as stock prices go up for that, right? And I won't complain, to be honest, if we have a strong stock market. But the other side of it, it keeps core services inflation, which is where financial services is a big piece of that. It keeps that elevated. My fear is that I think there's some chance, maybe I'll put a very subjective number, a 20% chance that the Fed does not cut at all in 2025. I think that would be a mistake. But I'm curious where you are. I threw a lot out there, but take it wherever you want to go.
Yeah, I do think that would be a mistake. I think something that the Fed's going to be watching very carefully, especially post-election, is inflation expectations. When the Fed was hiking rate, when they were fighting inflation, they once they got on board, they were really focused on expectations. And every time the market tried to loosen things up a little bit, they came back pretty hard. They did more for an extended period, more consistently than I think many market participants thought that they would actually do. Inflation expectations right now are pretty modest by I think most measures. I was looking at the New York Fed's consumer survey, the 3-year inflation number that they had, 3-year inflation expectations. In July, which is a little bit ago now, but in July, it was the lowest number they had since they started doing that survey in 2013. Not only had inflation expectations came down, they were actually historically low. I mean, going back a decade, so it's not history isn't that long in that case. That's what I think. That's one of the things that they're going to be watching most closely, because there's a lot of talk about tariffs, what tariffs might actually mean. There are concerns about policy that might be pro-inflationary. Donald Trump was elected because a lot of people in the electorate thought that he would help to contain inflation. If that shifts meaningfully, then we start having risks. But right now, that number is actually pretty good.
No, exactly. And my hope is that the Fed focus on, like, to your point, forward-looking measures like consumer expectations of inflation, and for that matter, even market expectations and business expectations. All of that point to the fact that inflation's contained right now. Inflation probably close to 2%, right? Everything's consistent with that. It's just these lagging measures of inflation for, like I said, idiosyncratic reasons, right? It feels on the surface that, oh, inflation is elevated and they can't cut. I hope they don't fall for that, but that's my worry, right? So that's our first worry. Policy rate, monetary policy may push us into, I don't think, I should say, even if they don't have any rate cuts, I don't think we get a recession or anything like that next year, right? I don't know if you agree, Barry, but I don't think we'll get a recession. But it doesn't help, like I said, it doesn't help investments, whether it's non-residential investment or the housing sector, residential investment.
Yeah, I don't think it puts us on the path to a recession. I think that that's the way a lot of people think about recessions, is that there's this absolutely necessary path where you have one marker and you hit that marker, and then you have the next marker and you hit that marker, and then you have a recession. We just saw loud and clear over the last several years, those traditional markers, they don't work. You have to think about the why, which is one of the things I think that you did, Ryan did. This was before I joined up. You thought about the why and you said, we don't think there's going to be a recession. But you can also be in a position that you're more vulnerable to a shock. And a shock, by definition, is not something that you can predict. It's an unknown. So I don't think it puts us on any kind of necessary path to a recession. Maybe it makes us a little bit more vulnerable to a shock if we were to get one.
Sidetracking off the topic of shocks, right? Was how much of a shock, or maybe not, was it to have your daughter back at Thanksgiving?
Well, it was expected, but I don't think I realized how much of a shock it was until we dropped her off at the plane and came home again. Because I realized once again that there's this part of my brain that just kind of is used to knowing generally where she is, not her exact location, but is she with her friends? Is she home? You know, what is she up to? And then suddenly that part of my brain is turned off. And then you really feel it. But it was great. It was a lot of fun having her home. First year in college. Really proud of her, doing very well, working hard.
She broke
I think having a little bit of fun as well, but that's part of the college experience also.
Didn't she break something? Is she okay? Like her ACL?
She tore her ACL. She tore her ACL playing some intramural volleyball on the very first day of classes. And I've learned a lot about ACLs. I didn't know that you can choose not to repair your ACL. I mean, your leg is less stable, which is especially important if you're an athlete. But lots of people decide not to do the surgery. But she's young. She's going to be running around a lot more. So we've decided to actually do the surgery. So not in pain. It's painful when it first happens, but really not in a lot of pain. But set that up. That's part of the excitement for the year.
Hopefully she gets better over time, but I'm sure it was great to have her. I was just thinking about myself. I was away for 8 days, and I'm sure I've talked about this before. I have 8-year-old twins, and so they didn't obviously come with me to India. They went to Florida where my in-laws are. But yeah, within 3 or 4 days, I was like really missing them. And this is weird for me to say because I went to boarding school at the age of 8. And I was away from home, and I think, oh yeah, no, I could live with that. But as a parent, it's very different. It's like not see, and I was just away from my kids for like 8 days, and not a long time. But yeah, sending your kids off to college just seems like, oh my god, that's a big deal. And it's almost like, that's why I asked what I mentioned shock. It's almost shock, like, well, suddenly she's back, and like, oh, what do we do? You have to restart somehow.
We eat a lot more steak.
Yeah. So, speaking of shock, by the way, well, I don't know how long have we gone? Probably gone about 25 minutes or so. But if you do want to hear the latest from us, if you like Facts versus Feelings, the latest on this podcast, don't forget to subscribe to Facts versus Feelings, our podcast. You can also leave a review. We love your feedback. You can also email us at Facts versus Feelings. That's versus with a VS at carsongroup.com. So send in any questions. We'll tackle that as we go on these conversations on the podcast between Ryan and myself, and Barry as well, like every now and then. It's awesome to have you here, Barry. But
So I want to ask you on the policy side. Probably the number one question that we get after rates is about tariffs, and from a policy perspective, what do you see as the likelihood of a policy mistake around tariffs, and what you're thinking right now on tariffs?
I'm not worried about it. I'll put it that way. I'm not worried about the whole tariff thing, right? I mean, even if we do get tariffs, it's a one-time adjustment, right? As opposed to like, it's a one-time adjustment to prices. Maybe it takes prices from, let's say, the price of a good from 100 to 110. Yeah, it's unpleasant. No denying that. But unless tariffs go from like, you put 10% tariffs today, 10% next month, 10% after that, it's not really an increase in inflation. It's a one-time price adjustment. But at the same time, I don't think we really are getting those big tariffs. I mean, we just saw a cycle last week. I kind of missed it. I mean, I was going to ask you about it because Trump was musing about tariffs on Truth Social, saying, I'm going to put huge tariffs on China. Not even China, forget China, right? It was Canada and Mexico, like our largest trade partners. By the way, China is not our largest trade partner by any measure. It's Canada and it's Mexico. What do we import from Canada? It's mostly energy, by the way. Right? Just so that everyone knows. From Mexico, it's cars and things like that, but it's all GM and Ford, all these companies making cars there. But from Canada, it's mostly energy, right? And then we refine it, things like that, right? We get, I think, heavy crude from Canada, amongst other things, and then we refine that for some reason, whatever reason, legacy reasons. Our refineries are more catered towards refining heavy crude as opposed to sweet crude, right? But anyway, so Trump was musing about these tariffs. Stocks sold out for like maybe 5 minutes. And then, investors remembered that, oh, wait a minute. As far as Trump's concerned, his report card, his favorite report card, I think it's safe to say, is the stock market. He cares about the stock market. So then stocks rebounded. So I feel like there's a Trump put, right? Like we talk about the Fed put and things like that. I think this seems like a Trump put. Like markets are sort of like brushing aside the fact that, oh, yeah, he could put tariffs on, but if stocks react negatively, they'll pull back on that. And his picks, I mean, Lutnick at Commerce, right? Commerce. And then they seem very practical people. Wall Street's very practical. We talked about that last week. So I'm not too worried about tariffs. What I do worry about is, one reason I'm not worried about is the dollar going up. I think the dollar is going up and sort of front running tariffs. Because what does that do? If the dollar goes up, that price of the good that's $100, it went to 110 because of tariffs. If the dollar appreciates, it's no longer 110. Maybe it's only 103 or 104. Because the dollar is appreciated, it's made that foreign good cheaper, right? And I feel like the dollar is doing some of the work there. But I worry about the dollar. I don't think the dollar going up is a good thing for the U.S. I think it creates three headwinds. One is it creates, it makes U.S. goods more expensive. We are trying to revive our manufacturing sector, our export sector, right? If it makes our goods more expensive, the rest of the world, which is already struggling with growth, just buys less goods from the U.S., right? I think the dollar strength is also a headwind to S&P 500 earnings. I think about 40% of S&P 500 revenues come from outside the U.S. Now, a lot of that is invoiced in the dollar, but still, there's enough, money being made in local currencies. If the dollar is appreciating, that means those revenues in local currencies outside the U.S. is worth less. And then we talk about diversification in portfolios. Some part of that, obviously, U.S. equities have done really well, but you and you can talk about this as well. We would never say, your international equity allocation should be zero. No, right? There's some diversification benefit that comes from having international equities. Maybe less so than, 20 years ago, but it's not zero. It's not even, I wouldn't say you need more than 10% international equities, perhaps. But then if the US dollar is appreciating, for those of us, like most of our, clients, invest in international equities in the dollar, and that's a headwind. A strong dollar is a headwind to international equity returns. So that's why I worry about. I worry more about the dollar, the impact of the dollar because of that whole tariff threat, rather than the tariffs itself. If that makes sense, Barry.
Yeah, I think that makes a lot of sense. If you look at one area of the market that's been very risk efficient over the last 5 years and has done quite well. This is not a recommendation. This is looking backwards, but it was Japan, but it was hedged Japan. That is, take out the effects of the dollar, which comes with a little bit of cost. So that comes into play as well if you want to hedge. But you take out the effects of the dollar, you look at hedged Japan, and what it's done without that dollar effect. And it's not necessarily been one of the best performing, but the performance has been strong. And it's been very risk efficient at the same time. So, I hear a lot that across the board, all international investing has been terrible. But there are areas that have actually done well. Perspective of hedged Japan is one. Markets in India are interesting.
No, on that, here's some data for you, right? Over the last 30 years, right, the S&P 500 is up about 2,200% since December 31st, 1994. So it's 30 years minus 1 month through the end of November. 2,200% approximately. That's what the S&P 500 is. It's about 11% annualized. The MSCI India Index is up 3,000%. Just over 3,000%. So about 12.2% annualized. By the way, that tells you like even 1% annualized difference, 11% for the S&P 500, 12% for India, right? Now there's a currency impact and things like that, but set that aside for now, right? In 1%, that's instead of 2,200%, you have 3,000%, return, right? Over 30 years minus 1 month. By the way, the MSCI China Index was up 91%. Just 91%. That's an annualized return of 2% over the last 30 years. Just over 2%. That's incredible. I mean, and this gets to the final worry, which I'm going to talk about, which is valuations, right? The Indian market has always been more expensive, whether you take PE ratios, CAPE ratios, cyclically adjusted PE ratios, things like that. Whereas China and a lot of other EMs have been, quote unquote, cheaper, right? But, I'll put a pin in that, come back to, but just to stay on the tariffs conversation right here. Anything with, how are you thinking about tariffs here?
Yeah, I think my views on tariffs are pretty much aligned with you, in part because I read your stuff. So,
yes.
And evaluate the arguments. If there's an effect from tariffs, it's going to be delayed. And I think that this is recognized that some of the talk on tariffs is a negotiating position. And so it's not the end point; it's a starting point. And we'll have to see how it actually evolves. And the market is going to provide feedback. Sounds like if President Xi in China took the market as feedback from what you were just saying, the feedback would be very negative. So obviously doesn't do that. Not a market economy. It's still called a communist country. I don't know if that's actually true, but certainly not a market economy at all. So we'll have that feedback cycle, and I think there are personnel in place who have a good dose of pragmatism as well. So you see the sometimes hyperbolic rhetoric, and the saying from Trump's supporters, which I think actually makes sense, is take him seriously, but don't take him literally. And I think that that's correct. I think we need to wait and see on what we're going to get from the tariffs.
Do you think there is a Trump put? I mean, I kind of only half jokingly framed it that way, the Trump put for the stock market, like the stock market being his report card, so to speak. And do you think that's a good thing? I'm curious.
I think that the market can be in a mood. The market collectively is pretty wise, but sometimes it can get a little bit overly influenced by sentiment. Sentiment can take hold of the market. So even though the market is wise, sentiment can take hold. And if you're watching the markets, it can lead you in the wrong direction. So I like the fact that there's this kind of pragmatic feedback loop. I think that that's positive, but I think you can go too far with it as well.
It's a nice way to frame it. But speaking of sentiment, let's get to a third worry, which is something I think we've heard about consistently, not just over the last year or 2 years. I feel like I've been hearing about it the last 5 years and maybe even longer, that the US market is too expensive. PE ratios, things like that. And why I'm tying it to sentiment because is I find it hard to think about valuations. I mean, it makes sense, right? Like to say, don't buy stuff that's expensive. Okay, easier said than done. I think it totally makes sense within the context of individual companies, stocks, things like that. Now, when you're talking about an index, like the S&P 500 index or the NASDAQ or the MSCI India index, whatever it is, I feel like it starts to get a little more tricky there. For one thing, it's like, okay, it's expensive, but relative to what? Now, it could be relative to its own history, but then you run into the problem like the S&P 500 of today is not the S&P 500 of 20 years ago, let alone 15 years ago. 15 years back, what energy and financials were the biggest part of the S&P 500 index. Right now, it's technology. Now, you could compare it to, other indices like like S&P 500 relative to large mid caps and small caps and international markets, things like that. But again, its composition is very different. The mid cap index is full of industrials, for example. The small cap index have more biotechs and financials, whereas the S&P 500 index is mostly like 30% tech or something like that. So again, I struggle with that. I'm curious how you think about valuations.
Yeah, it's question of valuations is always whether or not it's justified, and that's always relative to the circumstances. We know there are times when valuations can get ahead of themselves. We've seen it. We saw it with the dot-com bubble. Market up, especially if you look at growth stocks, wildly more than the 20% a year. Just shooting up and up and up and up, and the earnings just weren't there. And that was a case in which people said the earnings would come, but it got out of hand. The funny thing about the dot-com bubble is that everything that people thought would happen and were excited about actually came true. They just didn't invest in it very wisely and with the way that they went after it. But it's not speculative today when it comes to, say, the Mag 7, those big companies. These companies are actually big earners. They have good business models. It's not something that's going to happen in the future. There was a time when Amazon was speculative, a long period where they were building out their infrastructure. They weren't actually making a profit. It's not the state of Amazon today. So Mag 7 valuations, yes, they're on their higher end. They might be pumped up a little bit by sentiment, but these are also strong fundamental companies, and that's part of the story as well.
They have a ton of cash flow as well, right?
Yeah.
So I think about valuations as, look, if companies are doing well, if the market's doing well, valuations will increase. Whereas if you have a situation where people are pessimistic, right, like we're talking about facts versus feelings, I feel like valuations capture feelings. It's like, how much do I want to pay for, future earnings in a way, right? That's what valuations. I mean, if you look at future, PE ratios, things like that, however you measure it. And if I'm feeling optimistic, I'm willing to pay more for it. If I'm feeling pessimistic, I'll pay less for it. I know it's very simplistic, and then measuring it is a beast of a thing. But I feel that's the hardest part of our jobs with respect to figuring out, okay, what might be future returns, right? We are in the midst of our outlook, and I look at a lot of different outlooks. It looks like everybody, like all the sell side, right? Your Bank of America, Citigroups, Goldman Sachs, all of them are coming out with like, oh, the market's going to increase about 8-10% next year. Funnily enough, that is the average return for the S&P.
Yes. Yeah.
Right. And it was similar last year too. Now, one thing they pretty much nail, actually, to their credit, is how much earnings or profits are expected to grow. Right. What they miss is this valuation piece. Like if you think about total returns are, how much comes from earnings, how much comes from valuations, and then dividends, right? Dividends and earnings, you think about that like profits. They nail that piece, right? To almost to like whether it's $260 EPS, earnings per share for the S&P 500, whatever it is, right? They've nailed that part, but the valuation piece is just missing. But way I think about it is, look, if earnings start to increase a lot, people are going to be more optimistic, right? You get animal spirits, and that increases valuation. I mean, it's not like the S&P 500 today. It's about, I'm looking at it, 22x forward PE ratio, or price to earnings ratio. I don't know. Is that, Barry? You tell me. Is that fair valued? Is that overvalued? Like, is that undervalued? Like, I mean, you look at it, like the last 20 years, maybe the average is 18 or something like that. But like I said, 15 years ago, we had the index full of financials and energy companies, right? Which tend to be lower valued. Like, I guess my question is, why couldn't we see 28x? I'm not saying that's a good thing. I think I would probably say we're definitely overvalued at that point. But we know we're close to 28x. We're at 22x. But what do you think? Do we think we're fairly valued or overvalued?
We know in the long run there's a baseline which you're going to return to, and you can overshoot that baseline on the other side as well, which is one of the reasons why people get worried about valuations, is that things can be misvalued on the downside too. We haven't seen that in a while, but that happens also, and so it's a question of how far that rubber band gets stretched, and so you think about what's the point it's going to return to, but you don't know the timing of that. Valuations are an absolutely horrible 1 year forward predictor of returns. They just don't tell you anything looking ahead a year. They tell you a little bit looking ahead 5 years. They tell you a reasonable amount looking ahead 10 years. So if you're thinking 10 years, then valuations should matter. But what they tell you is not you're going to see an extreme, that for the next 10 years, U.S. equities are going to be negative, which is what I see sometimes in some strategic forecasts. It tells you that the evidence is they're going to be lower. They're going to be below average. Valuations maybe feel a tiny bit high, but if you think about giving that back over a 10-year period, what are you actually taking out of returns? I think people who say it's going to take 10% a year out of returns and we're just going to be flat for the next 10 years, that just doesn't make sense to me. If you said, well, it's possible that it's going to pull 2% a year out of returns, I don't know if that's the right number, but that's plausible. If you said to me it's going to pull 0.5% for returns, I would say, yeah, that one's entirely plausible. So it's just a question of what it's going to pull out over the whole period. We have had extremes of the market where you just don't get much from equities over a 10-year period, but that you can't forecast, and that's not what valuations actually tell you. If you want to be smart about taking valuations into account, give your expectations a little bit of a reasonable haircut.
Right. Yeah, I feel like valuations, coming back to what I was saying, is it's animal spirits or lack thereof, right? And I feel like we haven't had animal spirits for a while. I mean, this is something Ryan's always talked about, or over the last 2 years, really. This hasn't been a very loved bull market, right? To that point, I can see that it's almost time for another meeting. I'm sure you got that link because you and I are supposed to be in another meeting at this point, which probably means that we've gone over our time. But last point, do you agree with that? Do you think we've gotten animal spirits over the last 2 years, let alone 5 years or so?
Well, I mean, thinking about some things that have gone on, we know in elections across the globe, incumbents lost vote share and often were voted out. It didn't matter whether the person who was in power was on the right or the left. Whoever was in charge when inflation was high lost vote share, often got voted out altogether. That doesn't sound like animal spirits to me. That sounds like people were rejecting the status quo. If you look at consumer confidence, we know that inflation has been sticky in people's brains, and that's pulled down consumer confidence compared to, say, 2019. That stays low. People aren't confident. People are voting out across the globe. Whoever was in power during the high inflation period. That doesn't sound like animal spirits to me. That doesn't sound like high confidence to me. We know the market has done very well, but we also know that a lot of people didn't participate in that market. So I think the possibility is still there. You certainly can't say that over the last few years, people have been enthusiastic and have been over speculating.
No, I think that's a good place to end this. Yeah. Which means we could still see more animal spirits in the year to come or the years to come, really. because we probably haven't had enough of it, right? If at all. But with that,
sometimes you just need a change. Doesn't matter what that change is.
There you go. Well, thank you, Barry. This is awesome as always. It was fun to catch up. This is the first thing I did after coming back from my trip. So it was nice to catch up with you, and nice to catch up with all of you on the podcast. Hopefully you enjoyed that conversation. It's episode 112, I believe. I think it's 112. 3 things we're worried about, and at the end of the day, we're worried about these things, but that doesn't mean we think there'll be a recession or anything like that. Far from it, right? We think the positives and the opportunities overweigh everything we just talked about over here. So, and with that, thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Dietrich are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.